Hi, everyone. Welcome back to my channel's live stream. It is the day before Thanksgiving and the market has closed. We had a little bit of a down day today with the big indexes going down. The Dow Jones, S&P, and the NASDAQ went down a little bit. But the Russell did ink out a small gain, which was good to see. Some stocks that really moved today were around crypto. That really moved today. The Bitcoin is really moved up. It was up about 4.73 today. And look at Ethereum. It was up 9%. That caused stocks like Coinbase to go up substantially, as well as BTBT, which is a tiny little company I covered recently. I'll take a look at that one in a little bit and kind of show some of the details behind BTBT. But overall, we're having a fantastic November. Stocks have really gone up. I think the expectation is that stocks are really going to work for the next 4 years with the new administration that's going to go into office. So as we get started, if there's a stock you want to take a look at, please suggest it in the chat. I'll try to get to it. I've got a nice list of stocks, but I'm flexible. I'll go in a direction that the viewers want to go in. So very nice to see Shadow Guy on the stream. Happy Thanksgiving. And I hope you enjoy a nice meal in Switzerland tomorrow. And would be curious to see what you plan on having as a meal tomorrow, and if you're going to celebrate Thanksgiving. Android PC, very nice to see you. Thanks for joining. And Bad Omen, great to see you. Hopefully you are doing well. I am doing great. And you want to take a look at ZIM? I'd be happy to take a look at ZIM. It's one of the stocks that I bought today. In fact, why don't we start with ZIM? I'll show you what I'm seeing and why I decided to jump into that stock. So earlier in the week, I was kind of updated that, hey, there's going to be a big dividend coming. And I think the dividend was going to be above 16% as a dividend that would be paid to shareholders as of December 2nd. So I decided to just throw $5,000 at ZIM. I bought $1,000 followed by $5,000 today, and it went well. It went up. I'm probably up 4% on my position just in one day, and really I'm buying in for that dividend. We'll see if the stock settles down on Friday. There may be a lot of investors. Actually, it would settle down on Monday, because anybody who buys on Friday would still qualify for that dividend. So that dividend's coming. Now, this stock here, what's interesting is that they are generating so much cash, and they had such a great quarter. Let me show you some of those details. That it's kind of incredible that the stock hasn't gone up more. In the quarter, if you look at Q3, they grew 117% revenue. And when we look at their profitability, their gross profit is 57%. This is a shipping company. That's a very good rate to have a margin on their business. And EBITDA is solid. Free cash flow margin of 52%. That's just ridiculous in a positive way. That's just an incredible number. And that's why they're paying out this massive dividend. It looks like Bad Omen's got a few comments here. So let me catch up on those. So I bought $5,000 today into ZIM. Am I going to buy more? Probably not. I'm just going to let the 5,000 ride and see what I want to do in about 2-3 weeks time. I think it's a pretty strong proposition to buy this stock, or it's too attractive to ignore. And 5,000 is a good amount. I don't want to get too out there. I don't like to buy big positions all at once. I like to dollar cost average. The one thing that does worry me about ZIM is, the trade war or tariffs coming into the picture may slow down commerce. I think that's a small worry. I don't think it's going to be that bad. if there's new tariffs that are going to be put in place. But that could affect it, right? That could affect, if anything, if you have shipping volumes go down a little bit and that causes rates to go down substantially, then ZIM's going to lose a lot of their profitability. So I'm buying in $5,000 and then may buy some more maybe in about 2-3 weeks time. Looks like Shadow Guy for Thanksgiving. We'll have pasta and a salad. All right. Well, that's a pretty good meal. So I hope you enjoy it. So ZIM is just a really attractive buy. If you look at the company, I mean, every way I look at it, and I'll show you my valuation of ZIM. So, I mean, the numbers on the cash flow are just ridiculous. Look at this discount. Just it's so much more valuable. Keep in mind, their market cap, and I know it's higher than that now. This is behind the times a little bit. But when I bought the stock this morning, the market cap's 2.6 billion. And you look at how much cash flow they're producing on the trailing 12 months, that they're producing almost as much cash flow as their market cap. They're just really, really cash rich at the current time. So that looks outstanding. If they can sustain that, they had a period of time about 3 years ago when they provided dividends basically that gave stockholders all their money back for their stock. And that might happen again if they keep at it. I mean, giving out a 16% dividend in the quarter is pretty attractive. If they keep doing that year after year, I could recoup my investment and then just let the stock ride, or just sell the stock at a complete profit because I got my investment back. So no matter how I slice it, ZIM just looks really good. I think the company is doing really good things. They bought new ships. Their new ships are efficient, and it's looking good. So Brad, you're buying into, and I've seen you mention that Hafnia. Let's take a look at Hafnia. I think it's another shipping company. It was up substantially today as well. 5.8%. Dividend of 28%. Holy smokes. Man, what is going on? That's just really hard to believe that you have dividends that high on these stocks. And these shouldn't come to a surprise, right? Like ZIM, just a couple of years ago, they had these ridiculous dividends. And then the stock sold off, and now Hafnia and ZIM are having these really high dividends again. So here we go again. Hafnia has been growing well. If you look at the trailing 12 months, if we look at the quarterly, it's growing nicely. And who's bigger than who? These guys are 2.9. I think that ZIM is 7.5 million in revenue, and this is USD. Hafnia USD. So Hafnia is a little smaller. What's their gross profit margin? So the gross margin's a little lower. ZIM was at 57. This one's at 37. Free cash flow margin, 32%. That is excellent. That is looking great. I don't think you can go wrong with this one. I don't think you can go wrong with ZIM at the current time. Just the stock prices are, let's see how this one's done over time. So this one's only up 6%. Yeah, these stocks are kind of disrespected. They're left as an undesirable to some extent, that, hey, they're not an Nvidia or an Apple. And some investors like myself, and looks like you guys, appreciate these stocks because of the very strong economics behind these businesses. And I mean, the global economy, we are doing business with one another. We're buying a lot of stuff from all over the world, especially from China. So the trade between countries is not going to slow down. I know that it could be maybe slow down temporarily if too many tariffs come into the picture, but I think it's just going to continue to grow. We're going to need these ships. So Hafnia looks pretty good. I would still have to, obviously I'm investing in ZIM, so I feel very comfortable there. ZIM is my preference, and I'm glad I bought the shares today. And we'll let that 5,000 ride, maybe buy some more in 2-3 weeks. But both of these stocks, I mean, they look pretty darn good. They both look discounted if you look at their free cash flows, and the dividends are just going to reward investors. If you look at um, Hafnia, you're up 6%, but you need to add this dividend. So that's a great rate of return over the last year if you add the dividend. So looks good, and so does ZIM. So we're in an expensive market, but here's two stocks that look discounted to me. Look very, very well discounted. All right. So Android PC. Yeah. The gross profit and the profit margin, super impressive. Now, what ZIM did a couple of years ago is they invested a lot of the cash they made in 2021 and bought new ships. And I think that makes them a little more efficient. So it looks like Hafnia reported, huh? Let's take a look. Yep, they reported today. Let's take a look at what they had to say. Did it already get? No, it didn't get loaded there. So let's take a look at their financials. So these guys do more like ZIM does containers, right? Stuff that we would buy at Walmart gets put in a container. Looks like these guys do like petroleum products and that kind of thing. That's the kind of ship that I'm seeing there. Yeah, they're doing tankers. Okay. Okay, so make this a little bigger. I imagine it's pretty hard to read for you guys. And I will make myself tiny, try to get out of the way. All right, so revenue. So it looks like they both have their own vessels, and then they also probably lease out, or I forgot the term that they use, but they get other ships that somebody else owns. Now, last 3 months they grew 51 million, and I am assuming this is in US dollars. I'll confirm that later. So if they grew 51 million, then they grew about, I don't know, 17% or 16 to 17% over the last 9 months. Their growth hasn't been all that great because they went from 1,036,000,000 up to 1,157,000,000. So it's about $121 million of growth. On this kind of number, you're looking at about 11% growth. So, but the company's growing, so that looks good. Now, these guys are moving liquids, right? Probably primarily fuels, oil and that kind of thing. So they have, and this is a European company because they put everything kind of backwards compared to the US. So total plant, where there's restricted cash. Not seeing their cash just yet. Here it is. So 197 million in cash. Cash balance grown. That's good. And they owe 259 million in debt. Now, it's expected that they have a lot of debt because they have to run these ships. So that's not a big surprise. Now they announced, and did they announce before or after? In the stock pops, so I'm imagining, and they're in Europe, so they announced before the market opened. So the market really liked what they saw. Maybe that's what drove a little bit of the ZIM rally, but looks like the earnings were good. They're growing their revenue. They are moving more tanker, type of product, crude oil, that kind of thing. Those types of liquids that have to be moved from one area of the world to the next. Yeah, these two, I mean, they're working. Not a bad place to be. Right now it's an expensive market. And I mean, I'm holding back from buying too much into some stocks that I really like, but they really moved. The one that I'll highlight is DocuSign. I bought some DocuSign today, but I'm not going to buy a whole lot more. And the reason for it is when you look at DocuSign, I own about 32,000 of it. And I'm good owning about 32,000 in a small software company. I'm doing well with the investment, up 55%. And, but I still, I think there's a little more value to be attained there, about 12% more value. I think the stock's discounted by 12%, but the stock's really rallied. I think it's close to doubled in value in 1 year. So I'm good with DocuSign. Now, that's the profile there. I just showed you ZIM, which I think I have up here, and I don't have it updated yet. So I'll come back to this guy. When we look at ZIM, it's highly discounted. They are generating a lot more cash than DocuSign. And so it looks really good to me. I just don't see a lot of risk, a lot of downside risk. I just see a lot of cash being generated. And if we get a lot of dividends out of stocks like ZIM or Hafnia, I mean, we kind of just take the money and bank it, buy more shares or cash it out and treat it as maybe a riskier stock. You see how I'm discounting ZIM by 12%? That's a very high discount rate where I'm only discounting like DocuSign by 9%. So it's not a bad place to be. I might talk myself into buying more ZIM. I bought $5,000 today. Maybe I'll buy another couple of thousand before the month of December is done and just keep adding to it because I really like the numbers I'm seeing. I took a realized gain earlier in the year on ZIM. I did really well with it. I just thought that it was really risky stock. And my observation is the market, doesn't really treat ZIM or Hafnia with kind of like they don't look at the fundamentals purely. I don't think the market, the stock market and the buyers of stocks really appreciate these shipping companies all that much. They think it's going to be a very cyclical industry potentially. So they just buy, hold, and then sell. Well, I sensed that, hey, at this point, I sold on one of these peaks. I got out of the stock, made money because I bought way back here and just banked the profit. And now I'm removed from that event like 4 or 5 months. And now I'm buying back in. Hopefully it'll be another successful hold on ZIM. So 2 really good stocks and generating a lot of cash and that are discounted. All right. Thanks for all the comments, guys. Looks like Shadow Guy. So what are we having for Thanksgiving? Please put it in the chat. So speaking for myself, I play now and I pay later on Thanksgiving. My sister's going to host and she does a tremendous job. She'll do a turkey. She'll make enough food to feed everybody about at least 4x. So we all get to take stuff home. And she'll make a really good stuffing. She'll make like, I'm not exaggerating, like 8 different sides. And so it'll be really nice. It'll be really nice to see everybody. Probably we're going to get back to full capacity around the Thanksgiving table. I know COVID kept a lot of our relatives away from Southern California, but this year, boy, they've come out of the woodwork. So we're going to have a full table and then some. So that'll be what's on deck. One of my favorites is, I'll have a little bit of turkey just to say I had it, but I love the stuffing. I'm a big fan of the stuffing. I'm a big fan of, all the different dishes, good cranberry sauce. She'll make a few salads that are her bean salad is phenomenal. And so I'm a fan of Thanksgiving. I think the sides are always, to me, better, tastier. So that's what I'm going to have. Now I said play now, pay later, because tomorrow we get to skate by just by doing dishes at the end of the meal. But Christmas I host, so I'll be catering and making a big meal for everybody. And I'm thinking prime rib, and I'm thinking some kind of fish, so those that want to go lighter can go lighter, and just having a bunch of sides and just having a good time with my family. So everybody put in the chat what you plan on having for Thanksgiving. And I'd be really curious if somebody's going to DoorDash their meal. That'd be hilarious. Wouldn't be surprised. I think my 20-year-old son would probably DoorDash quite well for Thanksgiving and probably have a nice meal on the table. So Brad, it seems as oil moves, so does their stock. Yeah, I think so. And I think oil, if you see like for Hafnia, if you see a very cold winter, their stock's going to rally because there'll need to be more heating oil moved into that region. If you see more conflict, their stock's going to rally because certain areas of conflict that are producing oil will not be able to produce quantities that they're needing to produce, and they'll have to move oil from one part of the globe to another. So those two things are in play as well. But again, shipping industry is not a bad place to be right now. Falls Grave. So last week you bought Enphase, Supermicro, and ATAI. Not familiar with ATAI. I'm familiar with Enphase. Let's take a look at that one. Look at all three. I think Atai Life Sciences. Ooh, tiny market cap. Look at this chart. They're up 57%, but you see that this is a $1.73 right now. It's really come down. So net income, they're losing money, shares outstanding. Wow. Strong buy, it's discounted by 400%. So Atai Life Sciences, and a clinical stage biopharmaceutical company, develops and invests in various therapeutics to treat depression, anxiety, addiction, and other mental disorders. Okay. So I'm reading some of these headlines, trying to see what's going on with the company. This looks interesting. What you gotta, in my opinion, in order for me to buy into a stock like this, I really need to know if what they're doing is going to work, and are their drugs through the FDA's approval process? Are they already in commercial markets, like selling their pharmaceuticals? So that's important to know. They are not generating revenue. This is basically $330,000. So they're not probably commercially selling their drug just yet. So this one here is high risk, high reward. If they get their drug and their drug works, this is going to very quickly turn into something, but it doesn't come without a lot of risk. This one could go to zero or close to zero. It's not the type of investment that I'd like to make. It's not an industry that I have a lot of insight into, not enough. Like, I've worked in the software field for a long time. If you showed me a software company and you explained what they do, I'd probably say, hey, there's very few competitors there. That's a really good idea. These guys can make it. I think there's a big addressable market. I have that type of insight because I've worked in that industry. I can't say that about this. It'd just be probably more common business person's kind of knowledge of that industry. So I'd probably stay away from this stock just because it's high risk, high reward for somebody who really knows their stuff on the industry, in my opinion. But I hope it works for you. I hope it goes from $1.73 to $5 and it rewards you. So that one was interesting. Now, N phase, I'm very familiar with. I should say I'm familiar with, not very. So they do home energy, a lot of solar components. They're about 10 million, 10 billion in market cap. Now it's expected that the solar industry is going to probably have a couple of tough years under Trump. They're not big green energy types. So that's just a reality. The PE is 166, but it's expected that they're going to go to about 21 in the future. That's not bad. Analysts think that it's pretty discounted. We saw a big stock drop, but that's really because look at this revenue. It's really dropping. Huh. Man, that revenue dropped. Yeah, I think solar is going to continue to be, used. The one thing that um, I continue to think about is AI is going to draw a lot of power. Creating all these power plants takes a long time. It's very capital intensive. But the solar, like I got solar installed on our house, and I pretty much replaced all our consumption of power with these solar panels. Well, that seemed pretty practical. If a lot of people put these things on their roofs, if commercial buildings put them on their roofs, if others started to put solar panels down and start selling the power, that'd make a lot of sense. So that's kind of a good thing for Enphase. But the revenue drops are really concerning. I would not touch this stock just because there's just too many things that are going up against it. It's you got an administration that's not pro clean energy, so that's going to hurt them. What's going to be the catalyst that's going to drive additional growth? I don't know. And the market doesn't like solar stocks right now. The market did like solar stocks in 2022, but their stock now is, it's down about 75% from its peak. So that's the Enphase story. Now, Super Micro is, man. Now, Super Micro, I started to short somewhere around here, and I made, 50% on the short and got out. And then the bottom fell out of this stock. If I had the courage and sold, when it was on its bottom there, I would have been like an 80% gain on that short. But this one here, I just would not touch Super Micro. When their auditor fired Super Micro, that really said a lot about, there's just a lot of questionable items on their financials. And once you let that out of the bag, I think they're just going to have a lot of trouble getting the market's confidence back. So I think it's going to bump along. If you consider these guys at their high, $120 per share. So that means that they were roughly more than about 3 times bigger from a market cap. And this was a small cap before this whole AI thing, right? If you look at the 5-year, back when they were just a company, they were bumping along, a $5 stock. And they went from like being a $5 stock to a $115 stock or $114 stock. So the rise was just incredible, but this just isn't sustainable. And they are a hardware company. Let's look at this margin. Software companies operate with like 70 to 85% margins, but hardware companies, look at this margin. These are thin margins. You still have to design your product. You have to get your product to market. You have to compete against a bunch of competitors and so forth. You only make 14% margins. Whereas if you look at, I'll look at Zoom, since I did a Zoom video today, and they're at 75% profit margins. So it's a very, very different place. And I've been in the software space for a while, and see the 76% margins compared to Supermicro is at 15. You got to sell a lot of revenue to make the same margin that your friends over at Zoom are producing. And that's been known in the industry for a super long time. The money is not in the hardware. The money is in the software. The money is in the IP that is very unique. And a lot of these hardware providers, they're selling things that are very comparable to their competition. Like Dell probably puts out high performance computing systems that are similar, maybe not as good, but similar to Supermicro. And a lot of their product is commoditized. So I would not be touching Supermicro. At best, I could see this stock going up a little bit, but I would not be surprised if this thing will test. It's going down to about zero, because I think the whole auditor firing the customer, that just doesn't happen. That just does not happen. Every once in a great while that happens, and I just wouldn't touch it. If it's a short-term move and you make some money, congrats. If it's a long-term move and you make lots of money, I'll be the first one to congratulate you. I'm just not seeing it. And this one's another risky stock. I shorted it. I'm glad I did so. I lost money on some shorts this year. I've recognized those losses, but I did make probably the most money on Supermicro when I shorted this one. I also shorted CrowdStrike, made money. I lost money in shorting Palantir. I lost money shorting NVIDIA. So I don't know. I'm not great at shorting stocks, but I think I got the Supermicro story right. And I would not be surprised if our friends at NVIDIA really should be about a $1 trillion company or lower. We'll see. We'll see what happens there. I'm still going to keep shorting NVIDIA, and I'm still going to be shorting Palantir. I'm going to wait until the first of the year to start doing that. All right. So let's get back to the comments here. Can we look at Carvana? Yeah, I can take a look at that. All right, so back to Thanksgiving, sweet potato souffle. Oh, yeah. Yeah, now we're talking. Yeah, that sounds really good. I'm glad I had lunch before this stream because so Scott coming in with the intel, and I think you're coming back to ATAI, and they had one drug that passed phase 1. So that's very encouraging. If they keep going, they get it to, commercially sellable, the company's going to be worth a lot more. So hopefully they do that. It seems like they're addressing a space that really needs as much, therapies as possible, mental health, and hopefully they get there. They help a lot of people. So I was wondering how low can pharma stocks go in 4 years of Trump? Yeah, I mean, that's a good question. I think good pharma companies are here to stay, right? 'Cause certain pharmaceuticals are just going to be out there, and I don't think the new administration is going to flip like all these already approved drugs, with Medicare and insurance. I think over time it'd probably be a headwind for pharmaceutical companies because the government, from what I understand, the new administration is going to try to lower spending. They're going to do that by, lowering potentially like, hey, everybody is accustomed to getting this one drug. It's expensive and maybe the results aren't great. Well, they might cut that and say, hey, we're not going to approve that anymore. So Medicare and drug insurance would not approve certain drugs. Now that's a whole speculation on my part. But I know that the new administration is really speaking about trying to really cut government substantially. And you're not going to get there without cutting healthcare. Healthcare is one of the biggest expenses on the government's budget. And, you got somebody in charge in RFK that has said some pretty radical things in the past about being anti the science the pharmaceutical companies put out there. So we'll see how that sorts itself out. But I do think it's a headwind for pharmaceutical companies. I still think there's value to be attained in pharmaceutical. I still think that certain pharmaceutical companies are worth holding. I own United Therapeutics. They're doing phenomenal, and they help a rare disease, people that have rare diseases. Um, and I have two other pharmaceutical stocks that are doing, really well. So I'm not going to get out of those positions, but I would agree with you that the new administration is just going to make it harder on pharma. We'll have to wait and see. So Scott's with Scott Due Diligence is in the stream. I appreciate you joining, Scott. Hope you're doing well. Good job on your videos, man. I've been watching them and commenting. So thanks for doing that. So NU, NU is kind of a usual suspect. We've covered NU multiple times on streams. It seems like people are really into that stock. We can take a look at it. Cool. So you bought, not sure which stock you're referring to. Maybe Hafnia still. So Shadow Guy, I just read an article. Thanksgiving is catching on here in Switzerland. Selling more meals. I don't know. I'm not a big investor in food companies, but it's good to see that Thanksgiving is getting popular in Switzerland. So it looks like, Brad, you're buying into NU. Interesting. Let's take a look at NU. So this one here, they're operating down in Latin America, in Brazil, Mexico, Colombia, Cayman Islands. They also are in Germany, but that's not Latin America, but Argentina is, Uruguay. So these guys are a pretty good market cap, 65 billion. It's pretty good. Revenue of 5 billion, 5.46. Financials, I heard this on the Compound, which is a stream. Josh Brown is probably a pretty well-known investor, and he and a partner have this pretty successsul channel on YouTube, and I watch it. And they were, I'm going to cite them. They said that financial services was the number one sector in 2024. I believe them because my financial stocks have done great, and some financials have done just great, man, off the charts. This one is, look at that, 64%. Not bad at all. They don't pay a dividend. That's fine. This is a growing company. Analysts think there's still more upside to go. They have had volatility. Look at these drops. Wow. Now these drops, to an investor of my type, I like these drops. You can come in and buy some stocks in a company that I really believe in. So these are not bad things for me. These are actually opportunities. These guys have really operated well. All right, so let's take a look at revenue. Look at this revenue. They were tiny, 161. And are we talking USD? We are talking USD. And now they're 9 billion. Good job. I'm looking at the wrong line. Apologize, but it's still incredible. 154 to 5.4 billion. Looks great. 73% revenue growth. And their book value, where is their, I think it's going to be on the balance sheet. So book value went from 27 cents to 159. I use book value when I look at a bank, and these guys are more of a bank. They're doing a lot of services that you would see a bank produce. They're trying to borrow money or through account holders, and then they lend it out and they try to make a differential, the net interest margin. That's how they make money. These guys have done a great job growing their book value. These guys are doing great. This is a really, really good idea. For me, I'm looking for ways to get a little bit out of the US. I love the US. I love my US stocks. It just feels like I got all my eggs in that basket. And here's an egg that you can put in Latin America, a lot of banking, a lot of growth. This isn't a bad idea. This is a good idea. So these guys are doing great. And we've had a recent drop. 65 billion. So they're not a small cap anymore. They're mid cap, in my opinion. I know I could be, maybe breaking a few of the models, but this looks pretty interesting. I'm going to take a closer look at it, but everything I'm seeing is real positive on NU. I like that pullback. They're doing great. They got plenty of room to grow down in Latin America. Stone Co did really, really well for a long time, and then it pulled back. But I think it's an interesting idea. I own financial services, but I don't think I own anything out of country right now. You can't really include PayPal out of the country, right? So my financial services have done really well. I've got a big bank in there, got insurance, got PayPal in there. Of course, I got crypto. This is probably the best percentage performer in the bunch. Robinhood did great this year. Ali Bank, I'm buying into Ali Bank currently. I know Mike, the dividend investor guy, I don't know if he's on, but he asked me why I was buying into it. And I just think that it was sold off for no reason. And the reason was that there was concern that there was going to be a lot of defaults on car loans. And I think it was more of a rumor than it was fact. And I started buying into them, and it's, so far so good. I'm up about 12%, and I continue to accumulate. I'm going to take my time with Ali because I already own a lot in financial services. I don't want it to get too out of hand, but the performance in financial services has been great. I would totally be on board with buying NU. I'm going to take a look at it and see if it's something I want to do, because I see a lot of things I like in NU. I like that they're out of the US. I have been trying to diversify out of the US just a little bit, not a whole lot, just a little bit. And that could be a play to diversify, start buying in South America as well as in Mexico. And those economies are doing well. They continue to grow. I know they have some other issues, like their currency isn't as stable as kind of they probably want. Mexico is doing well. Their GDP continues to grow. I'm not as familiar with Brazil, but I am familiar with Mexico. Mexico is doing well. So I'm going to take a closer look at NU. Everything that I just saw, I really liked. All right, so Bad Omen. Take a look at NTLA. I'm a little confused on what the analysis think about the stock. Curious as to the way you value NTLA. I don't think I've ever looked at NTLA. So we can look at it. All right. Thanks for joining, everybody. And thanks for all the comments. This is great. Thanks for the thoughts. Yeah, I saw that comment on TCMD, and she probably knows something, right? That's worth looking at. She wouldn't be buying, and that's one of the rules that is unfair, but it's whatever, right? Like these senators, like if somebody got inside information that was not a senator and they traded on it, they're going to be in a lot of trouble. If they get found out, fines, potentially jail time, just bad things are going to happen. If you're a senator or a congressman or woman, you get inside information, you can trade all day long, which doesn't seem fair, but it is the way it is. Yeah, I mean, it's out of country. I get you. It's just, I would kind of reverse engineer that on you, which is in the US, stocks are really expensive. And it's great. The stocks have gone up. I own them. Great. Awesome. They're not going to go up into the moon. They're gonna correct at some point. Well, diversification is about, trying to play healthy markets or healthy companies in strong markets. And if NU is a strong company, strong financial services bank company in Brazil, I'm good with that. There's probably going to be some adversity there, maybe a bad year here or there. But man, there's just so much growth to be had in Latin America with people needing banking and financial services. So, Yeah, I get your point. And I'm actually looking for some of that diversification. I'm also looking into India, which has been super hard for me. I don't know where to start there. So I'm starting with an industry that I am familiar with, which is software and everything around software. I started buying an ETF in Mexico. I own I own another company in Mexico, and then I own some bonds that are in Mexico. Yep. So Brazil ETF, which is yep. Yeah. So I think part of my NU research is going to be to study Brazil and try to understand, is their economy doing well? Is it expected to grow? Is it going to be okay? Um, and then here's another piece of advice, Michael Anthony. Look at PAGS. Thank you. I will look at both. I'll look at both and finish off my analysis there. All right. Cool. Thanks for the comments, guys. Let me try to get back to the comments at hand. So I think Carvana came up. We'll take a quick cruise through Carvana. I like the Carvana story because they dealt with a real bad situation. You know, the situation with used cars as we got out of COVID with all the lockdowns and so forth, there were some really bad supply chain constraints, which caused not enough supply to be in market. So the demand drove up prices. So used cars just went through the roof. But that caused our friends at Carvana to just have a boom period. The only problem is that those car prices began to just fall off a cliff. And when that happened was Carvana, just to use a simple example, maybe bought a car for 40 grand and was looking to sell it for 30. Well, that's a pretty good loss after you put money into that car. So they had that situation. Their cash dried up. They had a hard time getting working capital. And I mean, things got really bad for them. So they went from $360 a share down to, oh man, single digits, $7 a share. It got really, really damn scary. But Carvana, the management team there, stuck to it, stuck it out, and bam, the stock's just flourishing. Congratulations, Carvana. And congratulations, all the stockholders who took the ride with them. Because these guys were close to bankruptcy, and then they pulled it off. Over the past year, they're just booming 711%. Congratulations. Everybody that owns the stock, congratulations. The tip of the hat. Wow. Incredible. Now, how much room is left? Let's take a look. So they went, I mean, it's hard to see. They had a drop in revenue, but the profitability is, I think, where things got really ugly. So this is where they lost 1.5 billion in 1 year. That really, really hurt them. But they're back. They're back and they're strong, I think, or stronger than they were. Now, I'm going to look at two things. I'm going to look at cash flow. I'm going to look at their debt level to make sure they didn't, come up with a bunch of debt to get out of that big hole they were in. And now they're in a different hole. So right now they are operating cash flow 619. So free cash flow of 534,000. Now, I don't like their business. It's not like, oh, I love, car dealerships, used car dealerships. I think they do things differently at Carvana, which is great. It's really neat. But let's take a look at their margins. So gross margin, 20%, 16%. This is where they had a real problem, 9%. So this is an industry that's just not really attractive. Attractive is 85%. Like if you look at Google and Microsoft, you're way up there. And that's why those companies are so valuable. So the best I can do is multiply that 500 grand by 10 and I don't get nowhere near this number. I don't know where people get this number. These guys are driving free cash flow at like 1% yield. If you look at market cap, they're yielding 1%. That isn't good in any book, I don't think. And okay, so that's one strike, a big one. That's kind of a showstopper for me, but let's keep going. Now, balance sheet. So they have net debt of about 5 billion, EBITDA of 1 billion. So it would take them 5 years at their current run rate to pay off debt. I'm already like, okay, I don't want to invest in the company. Here's another reason why I wouldn't invest in the company. So it's a really neat story. Congratulations, Carvana. But to me, it just doesn't fit the profile I'm looking for. It's great that they kind of recovered their business. At some point, I just believe their valuation got out of hand. For all I know, these guys are going to figure it out and be worth even more. But I have to stick to the model that really helps me make money year after year. I'm having a great year this year. A lot of the stocks that I base on free cash flow and earnings per share. Banks is different. Banks I base on book value and earnings per share. And REITs I treat differently as well. So I got to stay in my lane and just say, hey, I don't understand Carvana. I don't see how they are this valuable at 53 billion. I wouldn't touch this. I like the company. I like the story. I think it's cool what they did, but I don't have to buy it. I'm in it to make money and not to reward a company for pulling off the impossible. All right. More comments. All right. What are your thoughts about Chinese stocks? I've invested, I'm holding, and I think they're going to come back. The reason for it is I think that a lot of focus is on the US and China trade. Like, okay, it's going to be harder to trade and for Chinese companies to sell into the US. I'll acknowledge that clearly. But what I'm playing is China's selling to the rest of Asia. China's selling to Latin America, Africa, Middle East. They're selling to Australia. They have really good relationships with Australia. So everything but the US, they're going to flourish. Their economy is growing at 5%, much faster than the US. The companies are profitable. Some of them are really, really profitable. So I'm in it to diversify into China, and I'm going to hold my shares in Baba. Baba is my biggest position, but I've also bought into other companies. They had a really good day today. I think they did quite well. I think there's a China stock list here. Let's take a quick peek at it. Yeah, so Baba went up 1.6. JD, which I own, not a lot of it, 5%. Li Auto, these guys, man, I keep telling myself I got to buy. I don't like car companies. I owned Ford, and it left me just, dissatisfied as a stockholder. They make a lot of money, but the stock market doesn't want to buy car companies other than Tesla and anybody who says they're going to revolutionize the space. But Li Auto is just crushing other competitors. They're growing their company really fast. And look at today, it was up almost 7%. So China stocks work today, but overall, China stocks over the last month have really suffered. The reality is that, I think Trump's, there's a storyline that I think he gets a lot of good marks on, and that's the way he stands up to China, so to speak. And he really doesn't mince words. He just goes straight after them. Again, I think that the China-US trade may go down a little bit, but China's going to flourish all around the world. So that's my feeling on that. You get about buying Carvana. Cool, man. What a juggernaut. Yeah. So is there another company like Carvana? We're looking at ZIM. You look at ZIM, it's just got so much stinking value. It's like at some point that thing's going to fly up to $50 a share. That's my feeling on ZIM. It could fly up to $50 a share and still the fundamentals would support that number. So we'll see where that goes. That's one to look at. Right now we're in an expensive market. So that's one I can put out there, and let me think about the others. So Mercado Libre and NU. So Mercado Libre is e-commerce, but they probably have financial services with Mercado Pago. Yeah. Yeah, I think Mercado Libre is expensive. I decided to buy more Amazon and Baba, and I'm good. I think Mercado Libre is a pretty expensive stock. I can't get that stock to value at their current stock price. Yep, JD had a nice day. Yeah, we covered ZIM. Ian, I don't know if you showed up a little bit late, but we covered ZIM in length. So take a look at the recording. You're looking at Wolf. See if we have time to go over Wolf. All right, so this might be a little bit of a marathon, guys. We got lots of people online, which is great. And I'm going to go as long as it takes to go over these stocks. All right, so we went over Carvana. And you got a little star because I think that's interesting. I'm going to go into it. Look into it, excuse me. Let's look at NTLA. Oh, typed it in the wrong field. Intalia Therapeutics. So Intalia Therapeutics, a genome editing company focused on development of curative therapeutics. The company's in vivo programs, phase 1 clinical trial. Okay. So they've been selling off, down 51%, market cap of 1.55 billion. They do have some revenue as opposed to the one we saw earlier. They are losing money. So this is a little concerning that they had revenues up at 57, came down to 33, up to 52, back down to 36. Why is revenue going up and down? In this industry, it should be, if you're successful, you go up and to the right, your revenue. You may have trouble being profitable because you're growing, or you're growing your products. Maybe you're spending more on production because you haven't hit scale. Maybe you have more selling expense because you're selling into a space that's not as familiar with your treatments. So all those things apply, but the top line to me is really important. And to me, just this is kind of a red flag. Like, why is this going up and down? That is a concern. Looking at so they're losing money. Okay. They're burning cash, a lot of it. And this one's going to go into the similar kind of area that I treated ATAI with, which was, if you really know this space, you really know the sciences, and you think these guys are going to make it, you can make potentially a lot of money. I'm not that person. I don't know the science in this area well enough to make that decision. Now I'm looking for cash, and they have basically 658, and they were burning, think about, so 658. They're burning about 363. So they've got about 2 years of cash at their current burn rate. And that's a fair amount of time if their science is going to get there. So for those that have the science background, can really make good decisions around this particular industry, this company, this could be an opportunity. It's not one for me because I just don't have the background, the knowledge to do so. But the fundamentals scare me away. All right, now let's talk about TCMD. So this is the one the senator is investing in. So this is where it was probably found out that the senator is investing. All right, so this guy, 454 million in market cap, so it's a small cap. Revenue is good. PEs look good. What about the growth? So growth is modest. So it's a small company and they're growing at a slow rate. It's a little bit of a surprise. What was the big news that we Saw this. So I guess that senator's purchase is what caused the stock to really move, which is a good reason. So this one here, I would do my homework on. I don't follow any senators. I don't follow politicians and see what they're doing. I try to go fundamentals and try to buy companies that I understand and then make the investment. This one really went up a lot. It could really come back down. So at this point, I'm not seeing like, oh my God, this is going to be a great opportunity. I'm not seeing a big news splash that, hey, they came out with something that's going to be really valuable. Their cash is call it 40 million, and they're a modest grower. That's what is throwing me off. How come they're not growing any much faster? The best I can do is, if they don't have a lot of debt, is get them to like a $400 million valuation. But let's see how much debt they have. Yeah, I mean, they're worth like 400 million in my book, maybe 600 million, but it's a lot of risk to have a little bit of upside. And it could continue to go up, but I just see, I'd have to understand their business. I think they're fairly priced at this point, and that's after having run up that fast. I don't see a giant, discount available on this stock. So interesting little company. Hopefully they make it. Hopefully they keep growing. I wonder what the analysts have to say. So no analysts cover it. Man, it's a total inside job. I also saw today that Donald Trump Jr. became an advisor at this one company, and the stock went up 100%. The company produces drones. So obviously, they're with that type of influence that Donald Trump Jr. has, he'll help the company. MCW has car wash. MCW. Okay, we'll look at that later. All right, went over TCMD. Now let me cover a stock that Mike, the dividend investor guy, wanted to cover. He shared it on Discord earlier today. And I think we've looked at this guy before. BWLPG Limited, an investment holding company, engages in ship owning and chartering activities worldwide. It operates through shipping, product services, the company involved in transportation, liquefied petroleum gas, and oils. So this is a little bit like NAFIA that we saw earlier. It's 1.71 billion, 3.5 billion in revenue. Look at these PEs. Whoa. 3.55, 7.25. Dividend, 26%. God, these numbers look so good. Really good growth. Very good growth. Let's take a look at their gross margin. 22%, not great. ZIM was number one. I think NAFIA was better than this. And this one's at, let's call it 23%. Free cash flow of $656 million, growing it nicely. So this is, I mean, again, the numbers look great. The risk to reward look really good on BW. You're going to be paid a very high dividend rate. At this rate, you'd recapture the value of the share price in like 4 years or less, because you compound. And there's a lot to like there. It's just the market, I don't think, is ever going to treat these companies like, hey, they're like Palantir, and they're just going to, rock it up. So that's one thing to be aware of. Now, this one has been selling off recently. And you can see this thing kind of picking up, especially if you have a really cold winter and you have to start moving a lot of this product from wherever it's being extracted and processed, put it onto these ships and move it to where it's needed. If that's the case, the rates for moving this product are really going to go up, and this company is probably going to do even better. They're already doing great. I mean, this one looks great. We look at we looked at free cash flow. It looks really good. Let's take a look at the balance sheet and make sure we don't have a bunch of debt. And actually, these companies that have such expensive ships, I kind of give them a little bit of a pass. 450 million in debt, but they have a lot of cash. So they're really in the hole for 183 million. That's not a lot. EBITDA is 600. They don't really have a lot of debt. They can pay off debt in less than half a year. So I really like what I'm seeing in BW, in ZIM, in Hafnia. These shipping companies look great. I know that Scott's due diligence covers shipping companies, and I mean, they're looking good to me. And it's hard to find discounted stocks in this market because it's pretty expensive. All right, so the second time I'm seeing Wolf, we can go over that one next. But hopefully Mike, the dividend investor guy, sees BWLP, looks good, that big dividend, and it's pulling back. So looks like the shipping industry is offering up what looks to be a really good opportunity. All right, so let's take a look at Wolf. Wolfspeed, okay. Wolfspeed operates as a band gap semiconductor company focused on silicon carbide and gallium nitride technologies in Europe, Hong Kong, China, and the rest of Asia Pacific. Okay. Wow, they're being sold off. 74%. They're losing a lot of money. Market cap of 1.14 billion. They're growing, but why are they losing so much money? So their gross profit is terrible. This is like single digit. What happened? Like they used to be, gross margins were okay, and now they're like terrible. So gross profit means, we're going to take selling, R&D, all these other kind of like, you got to operate the company and sell the product, but we're going to remove them. We want to see just the materials that we put into the product, the labor that we put into the product, just the direct prime cost of that product. What is that gross margin? And it's just really expensive. And it's like, what's broken there? What happened? Because they went from 242 to 77 to 50. It's like, oh, you're not going to survive if you cannot get a better gross profit, because you still have to sell it. You have to keep your research and development, or you'll be replaced by your competitors. And then you have to operate your business. You have to hire accountants and HR departments and that kind of thing. This one's kind of a broken business, and I wonder if they're fixing it. I'm sure they're working really hard at it. Now, is their cost, I'm guessing here, but is their cost going up because they have to start paying a royalty or something? Something broke, and that's why their stock's selling off so much. And I'd have to see that a couple of things that, hey, okay, they're fixing the business, and these guys are creating a product that really does have a really good addressable market. They really do have a good product for the market, and that market's worth having. If those two things are in place, I might be a buyer. Right now, the only semiconductor company I'm buying is Qualcomm, and Qualcomm is, kind of a very well-known factor. They are producing good cash. The stock is working. So you could see that you see that the stock's been selling off. it's an opportunity to buy into this. I think I'm wrong in saying it's working. I've been buying into this because I think that it's pretty big market cap, but when you look at their fundamentals, look really good. Free cash flow looks good. They pay dividend. I don't care about dividends, but if they pay it, it's nice to have. And I'm in agreement with the analysts that this thing is discounted. They're in the AI space a little bit, but their Snapdragon chip is really good. So I'm going to keep buying into Qualcomm. And Wolfspeed looks like a troubled company. We'll see if they can get themselves out of that nosedive. All right, Mike, the dividend investor guy. Hopefully you caught my BWLP review, because I did that one for you. Man, here we go. More comments. Awesome. Michael Anthony Kramer has this new CEO of NVIDIA on his show tonight. Okay. Okay. So did I read your comment wrong? No, CEO of NVIDIA. There's a new CEO at NVIDIA? I'll have to catch up with that news because I didn't hear about it. I'm short NVIDIA. I think this is going to be hard for them to sustain. I've started feeling that way back here. And so far, I'm not crazy. It hasn't gone up much higher. But I did lose money on this short position. At some points, I was making money. And I got out of the short position to harvest some losses. And I'm going to get back into a short position with NVIDIA probably at the very end of December. But that's my feeling on NVIDIA. I think the company is incredible. They have the best accelerated computing technology on the face of this earth. It's just, this is nuts. $3.31 trillion. This is a cyclical industry. And we'll see. We'll see if this thing becomes the first semiconductor company that's non-cyclical. It'd be incredible, but they've already been incredible already. So we'll see what happens there. It's a ticker. Okay, we'll put that one on the list. RCAT. And welcome NYC Urbanista. I was in New York City with my wife, I guess 2 weeks ago. Had a great time. The weather wasn't too bad, by the way. It was great. I'm from California. So we had a great time. And every time we go to New York, we end up walking like 10 miles a day, which is good. Good for my health. We had a lot of fun. And came back. I probably spent a little too much money, so it's time to make some money. So Michael Anthony, with all the shipper selling off. Yeah, we'll see. I think maybe the whole perception out there, the marketplace thinks that these tariffs are going to slow down shipping, and it just may slow down shipping. But for all we know, it creates new trade, which is, oh, well, if we're going to have a tariff against China, then we're going to buy the product in India and ship it even further to get it to market. Well, okay, the shipping companies are going to win that one because there's going to be more shipping from India to the US, or maybe they have to get it elsewhere that creates longer routes versus China to the Pacific coast or the West Coast of the United States. Same thing, over in the Atlantic side. So we'll see. We'll let those things sort out, but the fundamentals look great on these shipping companies. Yeah, I agree that Scott with Scott's Due Diligence has had excellent videos on shipping companies. And FYI, you can go on his channel and search like ZIM as an example, and you can see his review. He's probably reviewed it a few times. You can watch the most recent video and see the history of these videos. And you can see how he treats those companies. He focuses on primarily on free cash flow, where I do free cash flow and I also do earnings per share. But he is very disciplined in his approach. He also provides a lot of value add stuff that I don't provide on my reviews. He adds a lot of like the competitive information. I love when he gets to that section. He'll put all the shipping companies and you can see the different metrics. So I encourage you to visit Scott's Due Diligence channel. Take a look at it for shipping company videos as well as anything else. A lot of value add there. So Pfizer, CAG, ADM, all discounted. I don't disagree. I think Pfizer's discounted, but I think that one there I bought and I'm waiting to see if they can keep improving their business. This is what looked really encouraging about Pfizer is when you look at their revenue for the last quarter, look at this number, 31%, beautiful. And this is a big company. Okay. So when you grow that much, and if you start sustaining that growth, nobody's going to be able to like ignore it. They're going to be like, holy smokes, Pfizer's back. And hopefully this stock doubles. I've got, I don't know, $30,000, $40,000 position. I'm waiting to see if the next earnings look good. If they're at mid 30% growth, I'm going to put more money into it, but I think it looks really, really good. It looks like Michael Anthony, more comments on Pfizer. They pay a nice dividend. What is their dividend rate right now? 6.5. I mean, it doesn't keep up with ZIM or the shipping companies. Those are extreme. This one at 6.5, you can buy into a 6.5% dividend and have great upside. This stock was trading at $60 a share, and now it's down to 25. And their revenue, other than the 2 COVID years, you compare revenue before COVID to now, it's a bigger company. It's like 50% bigger if you look at revenue. But the stock is lower than it traded in 2019, which I think is an opportunity. I think Pfizer is somewhat misunderstood. And if they keep operating really well, I think the stock's going to go up. So Mike, the dividend investor guy, I handled BWLP, and then you got Hafnia in there. We covered Hafnia and ZIM earlier. The consensus on that is these are highly discounted stocks. Love the high dividends. And I don't think you can go wrong on those stocks. I think you can be paid a really high dividend and they're so darn discounted that a lot of good things can happen. You can be sitting on a nice gainer with a nice dividend was our conclusion there. So I covered BWLP because we noted that on the Discord, and that was our conclusion. Man, I think this is a record on comments, guys. So I really appreciate you tuning in and giving me all these comments. It's awesome. All right. Everybody have a great Thanksgiving. I appreciate that, Mike, and you do the same. UG is also cheap. Let's take a look at that later. So Wolf. Yeah, they've been taking some big losses. The biggest worry is that gross margin line, right? Is you're not making any money after you produce the darn product, you're going to go bankrupt. It's going to be hard. There's something there. There's probably something that's causing their cost to go up just on the product cost. And you think about, why can't they raise their prices? Is it competition? I mean, there's just a lot there to be concerned in my mind. Okay. All right. Tech is overbought in principle, but man, it's really worked for the last 2 years. Boy, it worked. It worked and then some. All right. So we're going to look at MCW. We're going to look at that next. Let's see here. All right. Let me take a break on comments. I'm going to get to them, guys. And let's take a look at MCW. So Mr. Car Wash. All right. So I don't think I would have ever invested in a car wash except near my home. This company came in and they built this new car wash and few people involved. And it's a very good car wash. You kind of drive in, washes your car, and then you're on your own to vacuum your car, finish the detail. Like they'll probably leave a few water spots so you dry those off, you armor all your tires and stuff. And you think about, it's a very consistent business. This one opens from I think from 7 a.m. I would say till about 8 p.m. They don't open like in the middle of the night. They do have some people there, just not a lot, maybe 3 people working there. And the volume of cars, I'm in Southern California. We love cars in California. They're doing a lot of volume. So 5 years ago, I would have probably said, okay, dead on arrival. I'm not interested. But now I'm like, wait, that looks like a pretty good business. But I'd like to see the fundamentals to see, is it a good business or not? The PE looks good for next year. This is a $2.6 billion market cap company. Revenue, you're paying about 2.5 times revenue. Okay. They are profitable. Now, are these guys considered a REIT? So consumer discretionary, I agree with that. Okay. No, they're not a REIT. Okay. So revenue growing nicely, nice green. Okay. Stable growth. All right. I'm good with that. Gross margins, 31%. That's very good for this type of business. Not bad. 30%. Free cash flow. Oof, they're burning cash. What's going on with cash? They're probably putting a lot of money back into their car wash centers. They have operating cash flow, but then you have this CapEx. And it looks like it's not going away. So those impressive machines that you put your car through, they cost a lot of money to maintain. And that's where it's eating up all that cash. So this one's a showstopper for me. If you can't produce free cash flow, this type of business, I'm not interested. It doesn't look like it's going to be temporary. Even if it maybe they got better at it and they got it down to 200, you're still not generating a whole lot of cash. So I think it's a success story on the top line where you're seeing 6 analysts review the stock saying it's 14% discounted on average. And they're looking at earnings per share, which you could probably value the company. Looks like they're using a multiple of 22, 20, 17 on the earnings per share. This one's not for me. I just don't think there's enough upside. The cash flow is not there. Growing is going to be really hard. These things take a long time to build. They take a lot of capital. We didn't even look at the balance sheet, but the balance sheet, I'm going to guess, is going to have a lot of debt. So they have $1.8 billion of debt and EBITDA of 266. So it would take them about, let's call it 7 years to pay off their debt. They're burning cash and it would take them 7 years to pay off their debt. No, thank you. I think it's sold off quite a bit. It's also a low price stock, right? Just out of the gate. I know some people would view it as, well, when it's a low price, it can go up really high, but it got low for a reason. Investors are not interested. So this one here has just got a lot of problems. No, thank you. I think I'll keep going and being a satisfied customer to my local car wash, but I don't need to buy it. All right. So that was MCW. Let me catch up on comments. Potential opportunity. Celsius. We've looked at Celsius a few times, and you know what? Let's look at it again because it's kind of being somewhat written off because their big competitor in Monster has been muscling them out of markets. But let's take a look at it. So you think Kennedy's not going to get confirmed? That's interesting. That's an interesting observation. The guy is a little unusual. I'm not getting political. I'm just like, I think the guy cut the head off of a whale and he drove with his kids in the car. That was unusual. He got in trouble for dropping off the carcass of a bear in Central Park in New York City. Okay, that's weird. It's just interesting, but we'll see. Maybe there'll be some senators that take offense to disrespecting the carcass of a bear. We'll see. So ASC, we'll take a look at that. Omar, what's up, man? Good to see you. Shipping companies look really good. The ocean shipping companies. I'm not referring to like ground transport, like the trucking companies. I didn't review any of those on this stream, but the shipping companies, ocean freight, look really good. All right, Whirlpool. This one here has been a sick puppy, Whirlpool, but let's see if the sick puppy has gotten healthy again. I haven't looked at it in a little while. The one thing I'll say about Whirlpool is they are the leader in appliances. They do a good job. I own a bunch of Whirlpool products. I've owned them for a while. And I know that they did really well when everybody was remodeling their house. Looks like the stock's been going places. Look at that. Stock was trading at 86-ish, and now it's up nicely. Okay. $6 billion market cap, revenues. Man, look at that. You're buying it at a third of its revenue level. So that's pretty impressive. High dividend, PE looks great. The last time I looked at it that I didn't like was the free cash flow. But you can see that I like doing this, which is, COVID kind of took some industries and really temporarily changed their revenues, either to the upside or to the downside. So I like looking at like 2019, which is a clean number, and saying, are you bigger or smaller? In their case, they're smaller. Well, that's bad. How come you haven't grown in the last 5 years? What happened? So that's a little bit of a red flag. Okay, revenue's not growing. People aren't getting as many appliances as they were before. Gross profit is okay, not great. Looks like in 2019 it was much better, about 800 million better. Okay, that's interesting. So free cash flow 440. And where's your gross margin? Gross margin. Here it is. So you see how their gross margin is getting worse. Okay. Interesting. Okay. So this one here at 400, I mean, I can't come close to 6 billion. To me, the company has been going down and the stock price went down for a reason. They're not showing me that they're really bouncing back just yet. I mean, look at the quarterly revenues down 19%. Yeah, this one here, the puppy is still sick. Still a sick puppy in my book. I wouldn't touch it. It's also really a consumer discretionary purchase, right? You can make your washing machine or your oven or your range last a little longer when times are a little tough. It's not like a necessity. So this one here, if we have any kind of downturn, they're going to feel it. And a lot of the people remodeled their houses during the COVID years when everybody's getting all that stimulus money. So they may be seeing that big trough in demand because people already have what they need in the appliance department. All right. So we went over Whirlpool just quickly. Yeah, I like what I'm seeing out of Pfizer. Insider buying at Wolf. Okay. Well, that's great. Yeah, I think the car wash, it's just so bowl. So what does bowl do? Is bowling alleys? Bolero. So this is a location based. Okay, they're not profitable. PE is really through the roof. So they're not generating free cash. Yeah, these businesses are tough. I consider this retail, right? They're opening their doors. People walk through them. It's always really expensive. The real estate's expensive. You got to hire employees, and it just sponges all the profits out of the business. So this one here is just not that compelling of a business to be an investor in. All right, and then ASC. Now that ASC is on the list. It's at the bottom of the list, but it's because it just came in after the others. So let's keep rolling here. All right, so we have 4 stocks to go, and that'll be the cutoff. I appreciate you guys tuning in, and we're going an hour and a half. It's been fun. It's been a really good session. So we're going to look at RCAT, Red Cat Holdings. So drone industry, okay. So did these guys pop today? Yeah, 11%. So JFK, excuse me, Trump Jr., he became an advisor. Unusual Machines. So I guess him becoming an advisor there caused other companies to also go up. So Red Cat. So these guys are a $700 million market cap company. Revenue is about 18.86 million. Wow, that's a big multiple on revenue. So net income, they're losing money. All right. So they do. So they do drones. They're growing very fast. It looks like they just got into production. Okay. And what's their gross margins? Gross margin. These margins are not very good. Yeah, this one here doesn't look great to me. Consider, my position is I'm 56. So when I look at risk, I don't want, I would love to have a company that, goes 10x. I have a couple of stocks that are on their way, so to speak. Bitcoin certainly is on its way. But I got to kind of be realistic, and in this industry here, this is more aerospace and like products. There's a lot of choices. And if I knew some really good information on this company, I might be an investor. That's not the case for me. But these margins look really bad. The revenue is really low, and the market cap is really high. People are excited about this space, but there's going to be a lot of companies that don't exist probably in 5 years in this industry. These guys are a little bit late to the game. Like Aero Environment's been around for like 15 years, and they've been doing drones for a long time. And other drone companies have been around for a long time. They really have their products really well established. So this one here really is a high risk stock to me that I would not invest in, because you just can't they don't have the fundamentals to value the company at 700 million. There's just so many things they're going to have to overcome, including very low margins. You cannot become very profitable if your margins are less than 20% in gross margin. So that's my comment on Red Cat. UGI. So UGI Corporation, together with its subs, distributes, stores, transports energy products, related services. The company operates through 4 segments: AmeriGas, propane. Okay. So they do transport. Do these guys transport like in trucks, or how do they do it? Do they have a pipeline? Yeah, these guys do own pipelines to distribute product, energy product. Okay. Okay, so these guys are in that space. Are they a limited partnership? So regulated gas. They're in Pennsylvania. Nope, they're not a limited partnership. Okay. All right, 6.45 billion in market cap. Revenues a little north of that. PE, forward PE looks really good. Dividend looks good. Cash flow. How come we're not seeing financials on 2024? Interesting. Okay. So usually where these things fall apart is CapEx. Let's take a look. Capital expenditures. See how the CapEx and the operating cash flow are so darn close? It leaves you with very little cash flow. That's what usually blows up my interest in these companies. The utility type companies, they just don't produce cash flow, and I don't like them. And if you look at, we'll see how this one charts, but if you look at utilities, most of the time, and there's something going on, which is the power companies, independent power companies are really going up in value because the AI build out and eventual consumption of power is really going to, I guess, require a lot of power. So right now, utilities are actually working quite well. But fundamentally, you see here, it's down 32%. If you look at most utility companies, your rate of return over 5 years is like, you're lucky to be at 20%. And that's not the investment I'm looking for. I'm looking for something that's going to go up and to the right, double in value every 5 years. So this one here is a no-go for me. Its fundamentals around free cash flow are not good. So Celsius. Let's talk about energy drinks. I think it's spelled Celsius wrong. Okay, these guys were kind of beaten down. They're still beaten down. 1 month, they're still beaten down. Okay, 6.6. They just announced on November 6th, 6.6 billion in market cap. Revenues 1.37. P ratio 39 and 33 next year. Revenue growth did slow down. Let's take a look here. It dropped quite a bit. And I think because Monster has got them out of a particular distribution contract, and Monster replaced them in a big distribution contract with one of the big breweries, I believe. And therefore, that loss of revenue is what drove the stock price down. Having suffered that loss of revenue, I mean, it was a big drop. Are they still profitable? Gross profit is still good. It's like around 45%. They lost a little bit of money. Okay. Free cash flow went way down. Yeah, these guys are hurting. Yeah, Celsius doesn't look good. Looks like they're going to have to figure out how to grow faster and how to beat their competition, because right now their competition really struck a blow against these guys. I think Monster really took a big part of their market share, and it's really hurting Celsius. So I would stay away from Celsius for now. It's not an investment I want to make. They got to figure it out and show that, hey, they're on their way up. Right now, it'd be a guess for me to say, oh, are they going to make it? I don't know. Monster and Red Bull are pretty darn strong. All right. And the finale, ASC. So Admore Shipping Corporation engages in the seaborne transportation of petroleum products and chemicals worldwide. So we've been going through a string of these. Look at this. 478 in market cap, 422 in revenue. PE is super low. Nice dividend. They are cash flow wise, they are generating cash flow. It did come down to 90. I mean, I could totally support this market cap and say that they're discounted. They're down 18%. You have very good choices in shipping. We just showed you ZIM, Hafnia. We talked about BWLP. Now you're looking at this one. You have good choices. I would pick one that has good momentum, the best fundamentals. You have very good choices. I don't like this one. It's a little bit small. It's less known for me, so I have to be fair. I just don't know this company. I'm very comfortable with ZIM. I bought ZIM. But this one here, the drop in free cash flow is a little bit concerning. They are in a space that is petroleum products and chemicals. The oil business looked good for about 2 weeks, and then it's just been okay ever since. Right when people knew that Trump was going to be president, the oil complex really took on a little more value. And we may be exporting more products, so these guys may benefit from it. You have good choices in shipping. They're all discounted. I would pick the one that's best for you. I'm going to stick with ZIM. And on the petroleum side, I'm a big Chevron stockholder. I'm going to sell some of my Chevron and probably buy one of the fracking companies because I think they're going to do quite well. Pump be my favorite one there. Pump, P-U-M-P. All right, guys. So I don't know how many stocks we reviewed, but I'm going to guess that it was about 15 to 20. Thanks for all the questions. So yeah, I could see them buying more. Michael Anthony, I could see Bull buying more locations. Just not intrinsically, it's not a really, really super valuable business, in my opinion. Yeah, I might have to DoorDash. No, I'm gonna get through with the live stream. I'm in California. I'm probably gonna hit the gym and probably have dinner with my wife. Yeah, the drone business, it's become pretty popular as many companies. I would just kind of cover that carefully because again, there's been some players that have been there for a while. Those guys are going to probably have a leg up on everybody else. Hey, thanks for all the questions, Mike and Anthony. I don't have time to cover that guy, but maybe on the next one. So, all right, everybody. So now that was a fun stream. Thanks for all the questions. I don't think I've ever gotten that many comments, so I appreciate everybody attending and appreciate you visiting the channel. And everybody, let's go ahead and land the plane on this. Everybody have a really nice Thanksgiving. I'm not going to stream probably until next week. It's just I've got family things to do tomorrow and Friday, but I'll be back next week. And if you're interested in joining our investor call this weekend, we have an investor call. I'll put the information in the details of the live stream. If you sign up, you get to attend our workshop on Saturday, and then we have an investor call on Sundays if you're interested in that. But I'll probably stream next week. We'll see if I can hit it on Monday afternoon, evening, or some other afternoon, evening next week. So everybody, thanks again for tuning in. I appreciate it. And I hope you have a really nice long weekend.